Hello and welcome to this introduction to investment security accounting, brought to you by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over trading, available for sale, and the held to maturity methods of accounting for our securities. Now, these methods only apply to debt and equity securities, which represent less than 20% ownership in the issuing firm. For percentages over that amount, there's different types of accounting treatments, such as the equity method, which we'll go over in a future video. Trading securities are when we purchase a security with the intent of only holding it for a short time frame. So they were looking at short-term gains and losses. A held to maturity security are only for debt securities in which we're willing and able to hold on to the security until its stated maturity date. And then finally, available for sale securities, which is anything that doesn't fit into the other two categories. Let's take a look at the accounting for trading securities. On the balance sheet, we're going to report these as current assets since, as we said, these are only short-term type of investments. We're also going to post any unrealized gains or losses to the income statement. Now, these are paper gains and losses. We haven't actually sold the security and realized those gains or losses as of yet. The way we come up with the gain or loss is by looking at the fair value, or the amount that we can sell the security for in the marketplace. In the accounting for a trading security, it's pretty straightforward. We're going to take our unrealized gain and loss. In this case, we have a gain of $1,349. Fortunately, our stock has gone up. And then we're going to post that gain to a valuation allowance, a debit side of our balance sheet, which will make our cost amount equal to the market value. And on the credit side, we're posting that gain to our income statement. And this is going to be adjusted each reporting period depending on how much and where the fair market value is at the end of each reporting time. Next, we have the held to maturity securities, and this is very straightforward. Again, this only applies to debt securities which have a maturity, so notes or bonds. On the balance sheet, we're going to record these at amortized cost, which takes into account transaction fees, but also any premiums or discounts that we're amortizing over the life of this security. If there's less than 1 year left on the maturity, we're going to classify it into current assets. If there's still more than a year left to go, we'll throw it into our non-current or long-term assets. The income statement is just the interest income on the security, even through to the maturity. The only thing we're posting is whatever we're earning on the investments in the form of interest. And finally, we have our available for sale securities. These are neither trading or held to maturity categories. And we're going to post the unrealized gains or losses and keep track of them similar to how we saw with trading securities. But in this case, we're going to post straight to equity instead of going through the income statement. So in this case, we have a little example of a stockholders' equity section of a balance sheet. We have our common stock, retained earnings, and also a section for unrealized gain losses on our available for sale securities. Let's take a look at an example. In this case, we've lost money, so we can see how it works the other way as well. We have an unrealized loss of $114, which we're going to post as a credit to the balance sheet and our valuation allowance. This will, since our fair market value is below cost, we're going to adjust $114 credit to the cost so that we equal the fair market value. And then, as we saw in the equity section, we're going to also post $114 debit on that side as well. And just like the trading securities we saw, we're going to adjust this to the fair market value each reporting period as it changes. And here's how the valuation adjustment looks on our balance sheet. We have our investment, which came in at a cost of $100, and that's going to stay the same. We're not going to adjust that. But what we're going to do to equal the market value, let's say it's $95, we're going to constantly adjust its valuation allowance so that the total equals the $95 or whatever the market value happens to be. Here's a summary of the treatments. We have a short-term focus on our trading securities, held to maturity, and the AFS, they just depend. The HTM can depend on the maturity, and the AFS just depends on the intention of the firm of how long they want to carry it for. Our valuation uses fair market value for AFS and trading, but for held to maturity, we're not considering the market value or price fluctuations at all. We're sticking with our amortized cost. And that's true for how we reflect it on the balance sheet as well. Whereas trading and AFS show the cost plus that valuation allowance to equal that fair market value we want to get to. That's it for our introduction to the investment securities accounting. If you have any questions, please feel free to email me at john@passingscorefinance.com. And as always, good luck on your exam.